All right, well, we're back, and this week I'm going to try and do the renewsing live. Well, not actually live, because I'm animated, thank you, Clinton, but I'm going to try and holla at you with what we took away from this news blip we've seen popping up everywhere. It's Michael Burry's 2 cents on the next bubble. Spoiler alert, it's ETFs, or more accurately, it's passive investing. Now, his name might not sound familiar, but he was the doctor turned investor that called the subprime meltdown. Or if that's not ringing a bell, Christian Bale portrayed him in The Big Short. The story originally ran in Bloomberg, and it was renewsed in many other places, with a common quote being, "The theater keeps getting more crowded, but the exit door is the same as it always was." Now, this is a good analogy for the potential risk he sees. If everybody tries to get out at once, they can't fit, and something's got to give. But before you go running for the door and swear off ETFs, let's unpack some more of this article. Burry notes that in the Russell 2000 index, nearly half of those stocks have average daily volume less than 5 million, with nearly a quarter less than 1 million. So with so little of the underlying stock trading, he sees huge issue with billions of dollars being indexed to those underlyings. Let's just take a look at one of the funds that tracks that Russell 2000, like the BlackRock issued ETF with ticker IWM. It has an AUM of nearly 39 billion. What would happen if everybody got scared of something in the market and wanted out? Billions could leave the fund and the rubber would hit the road. Those stocks would need to change hands and you would be subject to what is called liquidity risk, which means those assets can't be sold quickly enough without impacting the cost. Which brings me to another key term, impact cost, which quantifies that liquidity risk, meaning due to liquidity risk, when trying to sell more than the market would bear, in order to find a buyer, you might have to sell the stock lower than the current price. So the simple act of your trading means you could push that price lower. That's impact cost, your impact on the cost. Now, the impact cost and liquidity risk are usually minimal in normal times, but the rise in ETFs did somewhat remove that organic price discovery at each asset level. And this is a key point Burry makes. And this means that people might want to buy into the Russell 2000 ETF, but not necessarily have an opinion on LSC Communications, which is a company in that index. And on a systematic level, Burry is drawing parallels between the structure of ETFs as a mechanism, which somewhat unyokes that underlying asset from the top level, to his previous call on the overvaluation of mortgage-backed securities. However, there are a few differences. Firstly, I want to point out that the smallest assets in these indices often are a really small percent. For perspective, if an equal weight index that has 2,000 stocks, each stock would only be 1/10 of 1/2 of 1%. Meaning for a $1 million top line change, only $500 of each stock would need to be traded. And for a $1 billion change in the ETF, only $500,000 in each stock. However, most indices are market cap weighted, which means a relatively lesser weight for those smaller companies. And thusly, a relatively smaller amount of these assets would have to trade, even if a lot of assets moved in or out of the index. A second thing to point out is that this was directly tested in 2008 when the markets went down nearly 30% very quickly. ETFs went down in suit to follow. They did their job mimicking the market. True, the ETF market has grown, but while there are risks in the market, I don't see the analysis that shows this price discovery as necessarily catastrophically negative to the system. And that brings me to my third and main point, which is hinged on the fundamentals. Things as simple as PE. If you look at the ratio of price to earnings, you can ask yourself if you think these building block underlying companies in the index have hugely inflated prices based on their underlying fundamentals. And that's a huge difference in my opinion. If the stocks were truly mirroring the mortgage-backed securities, we would see ratios flying away to much higher levels, akin to the ninja mortgages. Surely there will always be mispricings in the market, and yes, this is truer in less traded or less analyzed names. But even if assets trade more than their average daily volume and the price goes down, a smart analyst or investor will realize this and will have an opportunity to purchase an asset at a relative discount and thus help equalize that price. There are certainly forces at play here, but I don't know if I agree it's as simple as some of these sound bites would have you believe. Anyway, that's just my 2 cents on the matter, but I would love to hear yours. Please leave some comments and let me know what you like, dislike, or want to hear more of.